Right now, we want to bring in our panel to talk a little more about this. Former Trump Treasury official Joe Lavorgna and former Biden Treasury official Kitty Richards. Joe, what do you think happened here? Because I know your take on all of this was that the government, the economy was in pretty good shape before everything happened in the Middle East. But these numbers suggest a little differently.
We kind of came right back, Becky, to where we were in the beginning of the quarter when the outlook was that things would be soft because of the shutdown. It would weigh on income. And as Steve related, you're going to get that payback in the first quarter of 26. So the economy, I think, still fundamentally is pretty healthy. The tax incentives on the building, especially the structures, 100% expensing. And then, of course, the no tax on tips and overtime is going to lead to huge refunds. The biggest issue, though, as you know, is what's happening in commodity markets and energy, because it takes what I believe is a very fundamentally solid economy, one that is going to accelerate, is now cast doubt on it, as you can see in markets, which are worried about the extent and duration of this energy move, because there's nothing that will take liquidity away from households faster than higher gas and oil prices.
Kitty, what do you think? I mean, obviously, the events that are happening on the ground right now are complicating any sort of clear vision on what we might be seeing in the economy. But these numbers do come as a surprise. What are you betting at this point, just in terms of where we stand?
You know, I think these new GDP numbers are surprising. They were much lower than expectations, but they are also consistent with what we've been seeing in the job market. So last month's job market report from BLS showed that we actually lost 92,000 jobs across the economy in February. They also revised down December jobs, and so it was negative. So I'm wondering if we're actually seeing some of those labor market indicators and GDP come into line. That does paint a softer picture. And of course, we're seeing inflation remaining elevated. And the fact that core PCE is still quite elevated, moving into a period where this, chaos in the Middle East, the war that Trump has embarked on, has caused gas prices to go up dramatically in the last week. Those will continue to rise. Oil is trading around $100 a barrel. When you add that on top of persistently high non-energy inflation, we could really start to see inflation tick up.
Hey, Kitty, two things. One is I love the book that's right behind your head. So I wanted to say I appreciate that. I caught that. I don't know if others caught that. I won't say more. Just on the left side of there.
1929.
No. It says too big to fail.
Oh, okay.
And then, Joe, it's nice to see you. My question, which relates to where I think Kitty was going with this, is what is the chance, and I know the administration's been pretty persistent with the idea that, if things can get resolved, all of a sudden the price of oil is going to go down again. But what is the chance it remains elevated for some period of time, even after fighting ends, if you believe that is even possible?
Well, the thing is, Andrew, when you get these big oil spikes, they tend to go up very steep. The slope on the line is high, it's sharp, it's almost a right angle. And generally, when the situation is resolved, prices come down. So whenever this crisis ends, and hopefully sooner than later, I do expect prices to go down. The problem is the length and depth with which these prices rise. In 22, we had a lot of stimulus. The economy was overheating. We had very strong job growth, 300,000. Now the job market, I would argue, is going to turn up because it will follow the CapEx trend and the pro-growth tax policy. But with this energy move, that kind of throws a wrinkle in things. It seems to be the markets are still betting on a relatively short conflict. That certainly will help. But again, the longer we keep these prices higher, inflation will go up, that will collapse real income, hurt spending, and lead to a stalling out in growth.
One thing to bear in mind.
Oh, go ahead, Kitty.
One thing to bear in mind about the job market is what we've seen over the past year is that a large share of job growth has been in the healthcare sector. And last year's budget bill, which cut taxes for the wealthy very steeply, but also cut Medicaid and failed to extend really important subsidies for Affordable Care Act coverage, has led to millions of Americans losing their health insurance. That is going to, and also they're facing rising costs for healthcare if they were able to keep their insurance. And that is going to have real impacts on the healthcare sector, on jobs, as well as on Americans' pocketbooks. And I think you're seeing some of those pressures also feed through to that disappointing consumer expenditure that we're seeing. Consumers are really strapped. They're seeing prices rise for utilities. They're seeing prices rise for gasoline. They're seeing prices rise for food, and premiums for healthcare going up by hundreds of dollars a month in many cases. And that's really putting a squeeze on their ability to spend. And consumer expenditures are the driver of GDP growth in this country. And so I'm not as sanguine about what's going to happen in the labor market or with GDP over the coming year.
Hey, Joe, do you worry about that? And I guess if you would put yourself in the Federal Reserve's position, do you worry more about the potential for a softening economy, a softening jobs market, or do you worry more about what these higher oil prices mean for inflation?
Well, on the labor markets, the real wages under the first 11 months, 12 months of President Trump's term have been very positive and very strong. Blue-collar workers have seen huge wage gains. The problem, of course, is now where we are with the situation in the Middle East. So to me, as I said earlier, the economy is fundamentally healthy. But this oil move is a concern, and I do believe, as I said many times, the Fed should be cutting interest rates to help the cyclical parts of the economy to grow, because the Trump tax plan is disinflationary because it increases the supply side of the economy. However, if you're the Fed, having gotten burned very badly with transitory in 22, 23, they're going to sit and wait, as Rick said earlier, and you see it in the markets, we're pricing out Fed easing. So it does cause a risk, because when in doubt, the Fed's going to sit back and is going to wait. They don't want inflation expectations to become unmoored. And because of that, nothing is going to happen. The yield curve is bare flattening. That's not going to be good for interest-sensitive activity, which is why what happens overseas needs to be resolved as soon as possible.